Welcome back to Strictly Money. I'm here with Brian Belski of BMO Capital Markets. Brian, I want to talk about dividends or really searching for yields because I think a lot of investors have been doing that given we are in a high interest rate environment. GICs are trying to buy, dividend stocks. Something that you noted in your report was that, companies like utilities, for example, or communication services, which traditionally pay dividends, they've been down and they're the worst performing sectors year to date. Why is that?
Well, I think the more simplistic you define your investment strategy, the more most likely that you will fail. And I think the things that we've talked about for much of my 34-year career is talking about dividend growth. And you have to be able to facilitate the growth over time. Many of these high yielding companies within utilities, communication services, some of the REITs can't facilitate the dividend going forward. And I think they have the higher risk of cutting that dividend because of maybe the debt. If you look at debt to equity ratios in the utility sector, they're at or near all time highs. And so I think that's what has concerned people in this higher rate environment. So the way that we look at dividend growth over time is you have to make sure that the company has the ability to pay the dividend over time, cash flow yields of the dividend yield above the market. And that's been a strategy that we've been running for clients at BMO, both in Canada and the United States for years. And it's one that has been able to throw off a lot of income that continues to be able to be afforded the person that's buying that instrument.
What's your outlook for bonds?
Well, I think we've entered a period where we can all be together. Let's all get along together. I mean, for years it was just buy bonds or just buy stocks, and I think we can be together again. And I think this notion of having parts of both stocks and bonds in your portfolio is very important, especially considering the kind of volatility we see in the bond market. A lot of people have given us guff, let's say, about being so bullish since 2009. We said that U.S. stocks are in a 25-year secular bull market. We still think that, but think about this. We've been for all intents and purposes, a 41-year bull market in bonds. And we've seen the great unwind the last couple of years. Now it's time to think about sprinkling in that bond market influence back into your total return portfolio. And I think it's going to be an important part of moderation going forward in all investment instruments.
Do you think that the TSX will continue to, well, I don't know if it's continue, but outperform the S&P? I know last year when I was talking to strategists, they thought that would happen and that would be the case. What are your thoughts?
Well, I think we've entered a period of the next 3 to 5 years where Canada and the United States can coexist very nicely together. I think
Okay.
the likelihood of the U.S. continuing to outperform is strong, like we've had this year, especially given the makeup of the index. But I think over the years, I think Canada's going to continue to catch pace. Number one, the changes in the index going forward, but also I think once we start to see more global synchronized growth later on, a couple 3 years from now, let's call it, Canada does very well because of the commodity structure within the oil patch, let's say, and in the metals and mining. So I think Canada is going to be playing a very strong game of catch up. From global markets perspective, I think it can continue to lead, but go along with the United States.
What are your take on financials right now, Brian?
We really like financials, partially because of the sentiment. Everybody hates them, number one. Number two, these banks in both Canada and the United States have over-reserved because of worried about loan payments and the economy going forward. We really, really like the big banks, especially in Canada, that are centered more toward the United States, namely BMO, RBC, and TD, because that's the growth engines going forward, whether or not it's the consumer bank and TD, the commercial bank and BMO, or the wealth management side of things in RBC. I think they're very similar to what's happening in Bank of America, JP Morgan, Citigroup in the U.S., and very well positioned with strong balance sheets that can continue to facilitate loan growth going forward.
Okay. We have a minute until the commercial break. I want to go back to the S&P 500. And we talked about this, or you alluded to this earlier. It's like the big 7 or 8 darlings that have been driving the S&P 500 higher. Are you starting to see a shift?
We are a little bit, but we're overweight the technology sector, but not all of the technology sector. And remember, as I said, the big 7 includes things like Amazon and Google and Netflix that are not tech stocks technically. And by the way, Tesla is also a consumer discretionary stock. So you have to be kind of careful with just throwing all that into technology. But I do think the broadening out in terms of other sectors, more cyclical areas, and even small cap is going to happen in the next 3 to 5 years. You got to position for the long term, not with
Yeah.
what's just happening today.
Okay. Much more to cover. We'll take a quick commercial break, and then I want to get your thoughts on some of the geopolitical risks that we're seeing and the impact that maybe China and India could have on our markets here. We'll be right back.